I'm going to show you how to turn a good system into an amazing system with just a few lines of code. Adding these lines of code could make you an additional $10,000, $25,000, or even $50,000 in profits instantly. Hi, I'm Jeff Swanson, and I have over 2 decades of experience trading the futures market. And I'm here to share my journey and to help you become a better and profitable systematic trader. Now, this is the third video in a series of videos about breakout trading. If you've missed the other videos, you're going to find a link below this one in the description. Today, we're going to talk about my Better Breakout trading strategy, which is a day trading strategy, and I've dramatically improved its ability to generate profits, and I'm going to show you exactly what I did. And this simple technique can be applied to your trading. Again, it's really easy to do, and it can help you generate tens of thousands of dollars quickly. All right, let's kick things off with a thought experiment.
Imagine we have two traders, both using identical trading systems on the NASDAQ futures market. The same buy and sell signals, the same stop loss and trailing stop parameters, and even the same starting account balance. It's as if they're in a perfectly synchronized trading experiment. You'd think their results after a year would be identical, right? Well, here's where it gets interesting. One trader's account ends up outperforming the other. Why? The difference comes down to one crucial factor: position size. See, one trader applied a strategic, risk-based position sizing method, while the other, well, they used a more standard approach, simply buying a set number of contracts without really considering risk or volatility. This one change, this single decision to use position sizing tied to risk, made all the difference in their trading results. And that's exactly what we're here to unpack today. Now, let's talk about what happens if you don't adapt your position size to risk. One of the most common approaches out there is fixed contract sizing, where you simply buy the same number of contracts each time you get a trade signal. Easy to understand, yes. But effective? Not necessarily. The problem with fixed sizing is that it completely ignores market volatility. Let's say your trading system signals a buy, and you go ahead and buy 5 contracts. That's fine if market conditions are calm, but what if volatility spikes? In a high volatility environment, that same 5 contract trade suddenly becomes a much bigger risk, potentially exposing you to a larger than expected drawdown. When you don't adjust position sizes based on risk, you're essentially letting the market decide how much of your capital is on the line. That's a dangerous game and one of the quickest ways to destabilize your trading account over time.
Now let's bring all of this theory to life. Let's dive into an example. And again, it's a simple trading system that I call Better Breakout. Now, this strategy was originally developed back in 2012, and I've modified it to trade the NASDAQ futures on a 5-minute chart. Here's how it works. Here we are inside TradeStation, looking at Better Breakout on the NASDAQ futures market on a 5-minute chart. And here's an example of a trade that it took. So we're getting in at this breakout level and closing at the end of the day. And we can see that we're trading 1 contract. Now, I have built into the strategy a position sizing model. So what we can do is come in here, enable position sizing by changing this to true, and we are risking 2% of our account, and I'm just going to say we have a $100,000 account, and the minimum that we'd ever want to trade is 1. So what we're going to do is close this out. You can see after it recalculates, this has now gone to 4. So TradeStation has determined that based upon our account size and our risk per trade, that we can trade 4 contracts. Let's explain this in more detail by taking a look at some slides. In trading, we're going to have an account size, and we're also going to have a stop amount for our given trading system. And this is the crux or the starting point for determining the number of contracts we want to trade. Now, the stop loss amount can also be thought as a risk per trade. And what this basically means is we want to limit our stops to 2% of our trading account size. This is something that you see often, and it's a great place to start. We don't want to risk more than 2% of our trading account on any given trade. So if we have a $10,000 trading account and we don't want to risk more than 2% per trade, what does that equal to? Well, we just multiply those together and that gives us $200. How did I do that? Our theoretical maximum amount we want to risk per trade. So if we have a trading system and we lose that $200 on our first trade, we now have $9,800 in our trading account. And if we want to only risk 2%, our next maximum theoretical loss will be $196. In other words, we don't want to have a stop loss that's larger than this value. All right, so that gives us this very simple formula, our account size times our risk per trade, and I'm recommending a risk per trade of about 2%. What's this given us? Our theoretical maximum amount we want to risk or lose on any given trade. What we're doing here is controlling our risk. With this formula, we're normalizing our risk to 2%. So as our account size grows or volatility changes in the market and our stop loss value changes, what we're doing is limiting the amount of risk we're putting on the table per trade. Again, this is called normalizing our risk. If we have a trading system that generates a $350 stop and we have a $10,000 account and we want to risk no more than 2%, this tells us we can't trade this system because a $350 stop violates our maximum risk. So you can see how helpful this is in helping you determine what your theoretical account size should be based upon the stop loss amount. Very helpful. All right, so let's go back to our $10,000 trading account with a 2% risk. Let's expand our formula to this. The number of contracts is going to be our account size times our percent risk divided by the stop loss. Now, the first part, the account size times the percent risk, we just saw. So we're just going to do that and then divide it by our stop loss, and this is going to tell us how many contracts or how many shares we can buy. So let's say we have a $25,000 trading account. We're going to risk 2%. We're going to multiply those and divide it by our stop loss. So let's go do that. So now we have 500 divided by our stop loss. And let's say our stop loss is $500 as well. 500 divided by 500, that gives us one contract. So with this particular setup, the most we want to risk is one contract. Now, let's say that we're going to keep our trading account the same, but we're going to get really brave here and risk 4% of our account. What would that look like? Well, our formula is going to stay the same. We're going to take $25,000, which we had before, and doing all the math here will get us to 2 contracts. So you can see as your account size grows or as you risk more per trade, you can increase the number of contracts. Likewise, if you change the denominator and have a smaller stop loss, you can trade more contracts. If you're finding value in this video, go ahead and like it and subscribe. It really helps me out and I really appreciate it. So this is the gist of position sizing. It's pretty straightforward, very simple math, but an incredibly powerful concept for us to normalize our risk. Ultimately, what happens is we do this with our trading system because our stop loss is probably going to vary. As the market gets more volatile, it's going to expand, making our stop loss bigger. Thus, because it's in the denominator, we're going to risk less. We're going to trade fewer contracts or fewer shares. Likewise, as our account grows, or the markets get calmer and our stop loss gets smaller, that allows us to trade more contracts. And we program this into our algorithms to normalize our risk over time and to produce a smoother and more profitable equity curve. Okay, you should have a better idea of what position sizing looks like. Let's see what it looks like inside of EasyLanguage. So here is the breakout strategy. And you can see I have one line of code here which calculates the position size. And this is a custom function that I wrote, and this of course is available to you for free. You can see we're passing in here. We just want the percent risk, our stop loss value, our equity size, and the minimum number of trades. That's it. Let's open this function up and we can see what it's doing. There's a lot of code up here above that's kind of doing some error checking, but it's not critical for the position sizing. All the position sizing happens right here. And it's very simple. It's exactly what you saw demonstrated earlier in this video. We're going to first determine our dollars to risk. So we're going to take our percent risk. In our case, a lot of times it's 2%. Personally, I will risk anywhere between 1% and 3% on my trading systems. And then we have our equity size. In our case, we were doing a $100,000 account. Then we simply take our dollars to risk, which we just calculated up here, and we're going to divide it by our stop loss. So you can see as our account sizes changes and our risk per trade changes, that will change the number of contracts. Likewise, the stop, as it gets bigger or smaller, will change the number of contracts. How this plays out, we can see that this particular system decided to trade or calculated to trade 4 contracts. That means it normalized our risk at a 2% level and said, hey, we're free to trade 4 contracts. Let's look at some others. Here is one that broke out and it traded 8. It ended up being a losing trade, but because the stop loss was probably a little tighter, we were able to trade 8 contracts. Here is another one over here where 3 contracts were used, and this is another one with 2 contracts were used. So you can see our strategy is dynamically picking or calculating position size to normalize our risk per trade. Now, what does this do to our trading system? Let's go take a look at the results. What we're going to do is compare Better Breakout with just trading a fixed size of 1 contract versus a 2% risk model. Let's take a look at our strategy here, trading 1 contract. So this is trading the fixed contract size, and we're going from 2012 to 2024. We can see we're generating just under $60,000 in profit, averaging $308 per trade. Now let's go ahead and enable the position sizing. With position sizing, we jump to over $112,000 in profit, averaging over $582 per trade. Now, remember, we're trading the same trading system, the same account size. Everything is the same, except we enabled a position sizing algorithm. And look at the increase in profit. On my website, you will find an article associated with this video, and we have the performance metrics here. We can see the fixed size has $59,000 in profit, the 2% risk, $112,000. And we can see we improved our profit factor. We have increased our average trade net profit. Our annual return is up. Our maximum drawdown is up a little bit, but we've also improved our net profit versus drawdown. So we can see adding a position sizing model really improves our performance metrics in a lot of different areas. These are incredible benefits, and you can add this to your own trading starting today. Let's tackle some rookie mistakes. First of all, let's tackle the common misconception, thinking a position sizing method can turn a mediocre system into a winner. Here's the truth. Position sizing isn't a magic fix. If your trading system doesn't have a solid foundation, even the best position sizing approach won't make it a profitable system in the long run. You should always start with a positive expectancy system, meaning it's capable of generating returns on the market before you do position sizing. Next, here's a mistake that every beginner should be wary of: risking too much per trade. It's easy to think that the higher risk per trade means faster growth, but the opposite is more likely true, and that is you are going to blow up your account. In professional trading, a common rule is to risk around 1 to 2% of your account. Why? Because this allows you to survive those long streaks of losing trades. Even the best trading system will experience losses, sometimes back to back. If you're risking 5%, 10%, or even more on any single trade, it won't be long before a few bad trades wipe out a significant portion of your capital. Remember, we want to preserve our capital so we can be in the game as long as possible.
Here's the bottom line. Keep your risk per trade at around 2% or lower. Now, this gives you breathing room to recover from those mistakes that you might make and drawdowns. It's all about protecting your account and your capital so you can stay in the game and continue to trade for the long haul. Remember, in trading, slow and steady win the race. Key takeaways? Well, strategic position sizing is a powerful tool when used with a robust trading system and the discipline for risk management. It's about managing your exposure and protecting your capital. And that's what position sizing does. It's an incredibly powerful tool and very simple to implement. And don't forget, you can always download the EasyLanguage code that I used in this video at my website, EasyLanguage Mastery. Be sure to look for that link in the description.